Right, good day fellow investors. This is Mapletree Industrial Trust first quarter FY 25-26 financial results dated 28 July 2025. Right, we'll quickly run through the results. All right, first quarter year-on-year results is NPI is up 0.8%, distribution to unit holders is down 4.1%, DPU is down 4.7%. Right, this is the number we watch carefully. DPU, right? DPU excluding divestment gains and one compensation is down 1.5%. Right, I'll try to explain why they start to use this number, because this is basically the last one. DPU excluding divestment gains and compensation, right, is basically their operational DPU, which is a fairer way of looking at their DPU, right? Because I feel like both MIT and MLT they have been guilty in recent years when times are good, right? Interest rates are low. They just pay out all the divestment gains to boost DPU. And I think that artificially boosted their DPU to an unsustainable level, and they stopped doing it. Right, so in my opinion, we'll rather try and track DPU from operations rather than other things, like just DPU alone. Because like I said, year on year, you look at last year, it's boosted by divestment gain. So not very fair to look at it as 4.7% drop. Right, I think 1.5% drop is more fair. Right, positive rental revisions across all property segments with a weighted average rental revision rate of 8.2% for Singapore portfolio. Right, Singapore portfolio always around this number. Right, last FY is 8.1%. Right, the rest I won't cover too much because I think it's not a big deal. Right, completing the divestment of Georgia data center. All right, whether or not this data center has empty issues or not, I'm not sure lah. This one I have to dig up later on if I have more time. All right, but this one has been announced since last FY. Alright, so last quarter they already discussed they will divest this. They did it at a good profit, so we are quite happy with that. They also try and divest 3 industrial properties in Singapore. Right, this one I think is relatively new. Alright, I'm not sure if it's related to the fact that these light industrial buildings are the one that are underperforming. Right, if you look at this, this is last FY's financial results. Right, so yeah, it could be that they're only 50% occupied. That's why they are actually divesting that, and if that is the case, then I'm quite happy but I need to look up for these 3 industrial properties a little bit more information about how they are why they're actually divesting it. But they divested it at a profit again, right? So kudos to them. Right, so they said that this about 80% of their debt hedged to fixed rate. Nothing new it's just slightly lower than last time. Right, aggregate leverage ratio I expect to decrease to 37% post completion of the proposed Singapore portfolio divestment, which I believe is the 3 light industrial buildings. Again, I think this is a step in the right direction. Alright, both Mapletree Logistics and Industrial have been boosting dividend by giving out divestment gains. Right, so the DPU looks good, but the debt is still high. Right, but that in the times where debt is cheap, I think it's okay but nowadays debt is not so cheap. Right, so it's smart to pay down their debt. Alright, so anytime the leverage ratio goes down, I think it's a good thing for the REIT. Right, so first quarter this year versus first quarter last year, right, to me this is slightly less important because I don't think industrial trust suffers from seasonality. For example, Mapletree Pen may have some more seasonality due to shopping, right, people maybe tend more to spend more during Christmas or something like that, but I don't think industrial trust is affected by this. Right, so I'll actually look at fourth quarter versus first quarter more. Right, but I'll just run through the numbers quickly. Gross revenue is up, right, so that's a good thing. Property expense is down. Net property income up is a good thing. Borrowing cost is down quite significantly, 6.4%. Alright, and this is partly due to actually FX, I believe. So borrowing cost here decreased due to weaker USD against SGD. So the fact that USD weakened against SGD lately got 2 effects. One, it does drop their revenue, but it also dropped their borrowing costs. So it's a one good one bad basically. Alright, so we look at the cash distribution declared by joint venture is down 25.9%. This looks very substantial, right? But we'll see later that actually this trend has been there for a while. Alright, so I'm not super worried about this. And also if you look at the size of this joint JV, right, actually it's quite small. I mean, how much further can it drop? That's what I'm just thinking. Percentage wise, it's not going to be a big factor in terms of DPU. Right, that's my thinking currently. Alright, but I need to do a deeper dive into this JV thing. I haven't had the time to do so yet. Okay, so anyway, moving forward, amount available for distribution down 4.2%. Right, unit holders down 4.3%. Actual distribution to unit holders is down 4.1%, right? Actual DPU is down 4.7%, that one we discussed earlier already, right? But if you look at operationally, it's down 1.5%. And if you look at this quarter, right, I think I mentioned in my last video that actually I expect this quarter DPU drop by 5%, right? The fact that DPU only dropped by later we look at quarter results. That's more fair, right? Actually, I was expecting the DPU here, which is fourth quarter last year to first quarter this year, to drop by 5%, but it only dropped by 2%, 2.7%. So actually their performance, I think, is slightly better than I expected. Right, anyway, back to here. This first quarter versus first quarter, right? Again, this operational DPU, and one thing I like about this is that finally there's no more funny things in the DPU. So the 3.27 is actually without divestment gains and compensation, because if you look at carefully, this is the first time that I believe there's no more divestment gains in their DPU, right? This is the first quarter, right? So 3.27 I believe should be a relatively sustainable DPU. So if I analyze this, is 13.08 as annual dividend based on price I saw on Friday evening, $2.02 is 6.4% yield, which is relatively decent considering the Japan and Singapore side is doing well, right? US is the problem, right? And I'll try and explain again the US problem, which actually I spotted a long time ago. I'm probably one of the first people to call out this US occupancy problem, right? The rest I won't talk about too much because I think they're repetitive from the last last quarterly results. This is more important, first quarter this year versus fourth quarter last year, because this is the closest data that we had, right? So revenue down 1.1%, operating expenses down 9.3%. So I'm really like the drop in operating expenses, right? Somehow they managed to control their operating expense very well this time, right? Net property income is up 1.9%, right? So not bad. Borrowing cost is down 4.9%, right? Cash from joint JV is down 9%. So this is why I say that actually this 25% drop from earlier, right? You look at 1 year ago, it looks at 25% drop, but the drop is already there. It's been there for a while, right? So the latest drop from the JV is actually 9%. Okay, then moving down, we just go straight to distribution unit holders, which is down 2.7%, and DPU is down 2.7%. So if you watch my last video, I already anticipated it'll be down by 5%. That was my guess based off just stripping out the divestment gains, which means that actually the performance, I think, is slightly better than what I expected. Right? So you can see again here what I was trying to say, right? That if you look at first quarter, right, the 3.27 is not boosted by any divestment gain. Whereas if you look at last fourth quarter, right, 3.36 actually boosted by this divestment gain at Tanglin Halt and this redevelopment project. Of course, it's not 13.4 plus 1.9 and they actually spread it over 4 quarters. So it's 13.4 divided by 4, and this 1.9 million, I think it's just 1.9 million, right? So it's 13.4 divided by 4 plus 1.9 million. That's how much I think the distribution last quarter was boosted by. All right, so I do believe that actually the REIT has shown improvement in operational DPU, because if you strip out the one-offs, right, you see that the DPU excluding divestment gains and one-off compensation in fourth quarter was by right 3.18, and now it's 3.27. So operationally they are doing better. All right, that's my opinion. All right. This is the one part not good about the REIT. NAV continuously dropping, right? So it's now 1.69, right? It may be one of the reasons why the share price is dropping as well, right? So anyway, moving forward, borrowing slightly down. The rest, the flat stuff, I don't want to talk about it. Our small changes, I also don't want to talk about it, right? Interest coverage ratio has been dropping, right? I think the last round it was something like 4 point something, times, I believe. Let me just do a quick check. 4.3 times. So you can see 31st March 2025, interest coverage ratio is still 4.3 times. So the interest coverage ratio is actually weakening, but it's still above 3 . If you look across the board, most of the big REITs, their interest coverage ratio is 3. So they are still very, very comfortable. Right? Not that they are in any deep issue. Right? Borrowings, I think slightly down. They've probably refinanced some. The last time I saw it was 21%. Now it's 17%. Right? For the fact that they have a lot of US debt, right? I'm still a bit concerned about whether or not their interest interest rate, basically the average borrowing cost, right, will go up or not, right? It's 3.1% now, right? Can it go up further? I think there's a possibility, right? I'm really hoping they can push that debt to JPY lah, but I don't know how much JPY debt can they actually take, given that it's not, the Japan portfolio isn't that big, right? So that's one way they can possibly save some money, hopefully. All right, not going to talk too much about this. Yeah, they seem to be leaning more to data centers. They somehow try to change the way they report things. Later I'll show you what how the change is. But now they group the data centers over the three countries together. Of the three countries, Japan and Singapore, I think probably doing pretty well. But America is the problem, right? So you can see they sort of revamp this to say that they say data centers and high-tech building and business space remain key growth areas. So I believe this yellow part and blue part are actually doing well. Right? The general industrial buildings provide stable income. All right, I suppose that's why they're selling it off, At least I hope that's the reason why. Right? If they're doing that and they're still making a profit off selling, then yeah, I'm quite happy with the REIT in that sense. Right? So I'm not going to talk too much about all this. Yeah, you can see the yellow part. Right, so yellow part is the high-tech building and business space. I thought this is the one they said they did this. Yeah, they said this part is doing well. Okay, sure. All right, anyway, I don't think that's such a big thing that we need to discuss too much about. It's quite well known. We've been covering it for a while. All right, so anyway, North America, we know it's a problem. Yeah, like I said before in the last video, when I see this type of things, I'm not very happy. It's like it suggests that the North America data centers got problems. And I think I want to thank Tom Chu, one of my subscribers. I think he actually discussed with me out on the last video that one of the reasons why they believe the data centers are not so well occupied, I believe occupancy is around 90%, if I'm not mistaken, for US, right? It's because AI data centers, which is the current trend, right? The demand for AI data centers is very high, all right? But the problem is that they are not actually, the data centers MIT tend to have in US tend to be smaller, and they don't have the power capacity to support an AI data center. So they are the old school type of data center, right? So that's why I say that there's a mismatch in terms of demand and what MIT has in terms of data centers in the US, right? So so there's this problem, right, that the data centers they have in the US are not AI ready, right? Or maybe they have to put in a lot of money to make it AI ready. So that may be why their occupancy for data center is around 90%, right? Let me check. I think info was in front. Sorry, yeah, it's around 90%. It's still around 90%. Okay, so that's the basic issue right now. So the American side is an issue, but the good point is that I think this is the first time the DPU from operations has turned around, right? So with that, I thank you for listening. Please do give me a like if you have enjoyed my presentation. Yep, that's all. Thanks.